Hello everyone, and welcome back to the QuantScore Financial Show, brought to you by Math and Maticians. If you're new here, every week we break down the market using algorithms and quantitative analysis we structured during our master's studies. This week we're diving deep into valuations, growth prospects, and our quant scores to uncover the most undervalued and overvalued stocks for the trading week of January 13th, 2025. Just a very important quick reminder. I'm not a financial advisor, and this is not financial advice. This is purely for educational purposes. So, if you're ready to level up your investing game, grab your notepad and let's get started. Alright, kicking things off this week, we're taking a look at Baidu, trading under the ticker symbol BIDU, is one of the leading technology companies in China. Known for its search engine and often touted as the Google of China, Baidu has expanded into various sectors, including artificial intelligence, autonomous driving, and cloud computing. Baidu's been on a roller coaster ride lately, currently at $77.43 a share, with a market cap of $28.43 billion. This volatility can be attributed to various factors, including market sentiment, regulatory changes, and the overall performance of the tech sector. Its P/E ratio of 10.85 is lower than the S&P 500 average, suggesting potential undervaluation. This could indicate that the market hasn't fully recognized Baidu's growth potential or that there are underlying risks that investors are wary of. However, its PEG ratio of 4.03 and forward P/E ratio of 7.58 paint a mixed picture. The high PEG ratio suggests that the stock might be overvalued when considering its growth prospects, while the forward P/E ratio indicates a more reasonable valuation in the future. Baidu's return on assets is 3.5%, which is a decent figure, showing that the company is relatively efficient in using its assets to generate earnings. But its return on equity, on the other hand, is sitting at a slightly better 8%. Quarterly earnings growth is positive, but relatively low at 6%, which may concern investors looking for high-growth opportunities. Despite this, our quant score for Baidu is a solid 24.0, suggesting oversold valuation. This score takes into account various financial metrics and indicates that Baidu has strong fundamentals despite its recent performance issues. This makes Baidu an interesting prospect for value investors. Those who believe in the long-term potential of Baidu's diverse business ventures might find this an opportune moment to invest. Let's move on to our next stock as we continue to explore the dynamic world of financial markets and undervalued investment opportunities. Next up, Bentley Systems, trading under the ticker symbol BSY. This software company trades at $45.86 per share with a market cap of $14.13 billion. Bentley's P/E ratio of 42.11 indicates a premium valuation. The PEG ratio of 3.66 and forward P/E ratio of 39.68 suggest strong growth potential. However, their return on assets is 5%, while return on equity is the highest on our undervalued list, currently at a remarkable 42%. Alternatively, Bentley Systems' quarterly earnings dropped by an insane 20%, but quarterly revenue growth was up at around 6%. Our quant score for Bentley Systems is a solid 16, showing there is plenty of upside available for Bentley. Let's see what our next stock has in store. Now let's talk real estate with Rexford Industrial Realty, ticker symbol REXR. This REIT is currently priced at $37.17 per share, with a market cap of $8.82 billion. REXR's P/E ratio of 31.1 suggests a premium valuation. The PEG ratio of 9.31 raises concerns about future growth prospects. Financials show a return on assets of 1.23% and return on equity of 0.0189. Quarterly earnings growth is solid at 10%, and revenue growth over the past quarter has been even better, nearly hitting 18%, indicating incredible performance over the past quarter. Our quant score for REXR is standing at a comfortable 16, suggesting strong room for growth given a high quant score relative to the rest of the undervalued stocks for the week. Let's move on to the next stock. Wilscott Mobile Mini Holdings, trading under the ticker WSC. This company sits at $34.99 per share with a market cap of $6.29 billion. WSC's P/E ratio of 283.5 suggests significant and outstanding overvaluation. However, the PEG ratio of 1.264 and forward PE ratio of 18.94 indicate potential future growth, so we please ask that you overlook their terrible price to earnings ratio. Financials show a return on assets of 6% and return on equity of 2%. Quarterly earnings growth is down 70% quarter over quarter, but somehow WSC is still somehow able to manage a quant score of 13, suggesting it might be a tremendous opportunity for huge potential the market is otherwise overlooking. Let's see what our next stock reveals. Monster Beverage, operating under the ticker symbol MNST, this beverage giant currently trades at $49.74 per share, with a market cap of $50.18 billion. Monster's PE ratio of 33.16 reflects its growth story. The PEG ratio of 1.606 and forward PE ratio of 26.53, suggesting strong metrics for continued growth potential. Financials show a return on assets of nearly 15% and return on equity of 23.5%. Quarterly earnings growth is currently negative from the last quarter, with a decline of 11%. Our quant score for Monster Beverage is currently sitting at 10, indicating it still has plenty of room to grow. Investors seeking explosive growth might want to look elsewhere, but investors looking for reasonable, consistent growth, this could be the company for you. Now that we have finished up our undervalued stocks of the week, let's move to our 5 stocks of the week that we believe are strongly overbought and need to drastically fall for a buying opportunity, or further increase to expand our put option availability and put option upside. First up for our overvalued stocks of the week of January 13th, 2025, we have Robinhood, trading under the ticker HOOD. This fintech disruptor currently trades at $40.08 per share, with a market cap of $36.08 billion. Robinhood's PE ratio of 70.36 suggests high investor expectations. Financials show a return on assets of 0.58% and return on equity of 0.0151. Quarterly earnings growth is 0.0762, and revenue growth is 6.6%, indicating growth from a small base. Our quant score for Robinhood is 42.0, the highest this week, suggesting significant potential. With its high valuation, our algorithmic model sees value in Robinhood's extremely overvaluation, seeing huge opportunity with put options for profits. Let's move on to our next overvalued stock of the week. TPG is a global alternative asset management firm trading under the same ticker symbol TPG. This private equity giant trades at $62.40 per share with a market cap of $24.09 billion. TPG's financials show a return on assets of 0.38% with a return on equity currently negative, down 1.4% on the quarter. As for TPG's growth metrics, their quarterly earnings growth remained the same with a 0% change. But on the other hand, TPG somehow amassed a quarterly revenue growth of 400%. Despite these figures, our quant score for TPG is 35, suggesting extreme value in its short-term volatility. Private equity firms often have volatile financials, making short-term trends less indicative. Our models see strong potential value in TPG's overvaluation, but is accompanied with high risk. So please ensure your due diligence. Let's move on to the next overvalued stock of the week. Next up, Cintas Corporation, trading under the ticker CTAS. This company is a major player in the uniform rental and facility services industry, providing essential products and services to businesses across North America. From uniforms and mats to restroom supplies and first aid products, Cintas has a wide range of offerings that cater to the needs of various industries. This industry leader trades at $189.30 per share, with a market cap of $77.74 billion. The company's stock has shown resilience and growth over the years, making it a favorite among investors looking for stability and long-term gains. Cintas's PE ratio of 46.51 reflects its steady growth. This price-to-earnings ratio indicates that investors are willing to pay a premium for the company's earnings, expecting continued performance and profitability. The PEG ratio of 3.987 and forward PE ratio of 45.66 suggest continued growth potential. These metrics highlight the company's ability to grow its earnings at a consistent rate, making it an attractive option for growth-oriented investors. Financials show a return on assets of 15% and an even stronger return on equity of nearly 41%. These figures demonstrate the company's efficiency in utilizing its assets and equity to generate profits, a key indicator of financial health. Quarterly earnings growth was 18%, and revenue growth is 7%, indicating consistent performance. This steady growth in earnings and revenue showcases the company's ability to maintain its market position and continue expanding its operations, exactly the opposite of what our algorithmic models are suggesting. Our quant score for Cintas is 26, suggesting great opportunities for put options against the company. While the company's strong fundamentals make it a solid investment, the high quant score clearly indicates the stock has factored in too much growth and has room to readjust. Let's move on to the next stock. Now, let's dive into biotechnology with BioNTech SE, trading under the ticker BNTX. This innovative company trades at $122.85 per share with a market cap of $29.28 billion. BioNTech's PEG ratio of 0.0449 suggests significant undervaluation. Financials are currently showing a negative return on assets and a negative return on equity, suggesting the company is currently not optimizing any of their investments. Our quant score for BioNTech is 22.0, suggesting extremely overbuying in association with the extreme returns over the past 2 years, but alternatively had a tremendous quarterly revenue and earnings growth. Let's move on to our fourth overvalued stocks of the week. Finally, let's wrap things up with Tetra Tech Inc., trading under the ticker TIC. This company has established itself as a leader in the consulting industry, providing innovative solutions in water, environment, infrastructure, resource management, and energy sectors. With a strong global presence, Tetra Tech has been able to leverage its expertise to drive significant growth and deliver value to its shareholders. This global company trades at $41.02 per share, with a market cap of $10.69 billion. This valuation reflects the market's confidence in Tetra Tech's ability to maintain its competitive edge and continue its upward trajectory. Investors are particularly drawn to its robust financial health and consistent performance over the years. Tetra Tech's PE ratio of 32.46 suggests a premium valuation. This indicates that investors are willing to pay a higher price for each dollar of earnings, reflecting their optimism about the company's future growth prospects. The high PE ratio is often seen in companies with strong growth potential and solid fundamentals. The PEG ratio of 2.231 and forward PE ratio of 27.32 indicate solid growth potential. The PEG ratio, which accounts for the company's growth rate, suggests that Tetra Tech is expected to grow at a healthy pace. The forward PE ratio, which looks at future earnings, also points to continued strong performance. Financials show a return on assets of 8% and return on equity of nearly 19%. These metrics highlight the company's efficiency in using its assets to generate earnings and its ability to provide returns to shareholders. A higher return on equity is often a sign of a well-managed company. Quarterly earnings growth is an incomprehensible 75%, and revenue growth of 8%, indicating consistent performance over the past 3 months. These figures demonstrate Tetra Tech's ability to steadily increase its earnings and revenue, which is crucial for long-term success. Consistent growth in these areas is a positive sign for investors. Our quant score for Tetra Tech is 14, suggesting plenty of room for the company to rebalance down to previously lower prices. This score takes into account various financial metrics and performance indicators, providing a comprehensive view of the company's overall health and stability. A high quant score is indicative of strong opportunity in the market, in this case overvalued opportunities with extremely room for the stock price to balance back down. While Tetra Tech is a strong company with solid fundamentals, investors should be mindful of the high valuation and consider the potential risks. Let's conclude our analysis by acknowledging Tetra Tech's impressive track record and its potential for future growth. And there you have it, folks, our top undervalued and overvalued stocks for the week of January 13th, 2025. Remember, this is just a starting point for your own research. Do your own due diligence and consult with a financial advisor or fully understand the risks associated before making any investment decisions. If you found this video helpful, please give it a thumbs up, subscribe to the channel if you enjoy the content we put out, and hit that notification bell for more market insights. Thanks for watching and see you next week.